Buying a home in Canada is a huge expense for normal citizens, and there are a bunch of additional costs that are attached to it, and one of them is the mortgage life insurance. So in this video I'm going to showcase you what are the key differences between the mortgage life insurance and the private or personal life insurance taken outside of mortgage. When you buy a home in Canada, it's almost certain that the lender where you're getting your mortgage from will try to package it and sell a mortgage insurance with it. The type of mortgage insurance I'm talking about is the one that pays off the outstanding mortgage balance in the event of death. The last thing you want for your loved ones and family to be responsible for a huge debt when you're gone. While the concept of mortgage insurance is obviously profitable, personal life insurance serves the same purpose. The difference between the personal life insurance is that it provides flexibility because it is not tied to any mortgage. Understanding the difference between these two products is really important to choose the right policy for yourself. I'm neither an insurance agent trying to sell any insurance product here nor any financial planner trying to advise for a better product. But instead, what I'm going to share here is simple based on my research and my perspective towards these two financial products. It is really important to understand what these products stand for and how they work. So let me start with the mortgage insurance first. Don't get tricked by the name, as there are two different types of mortgage insurance that come in play when someone buys a property. The first one is mortgage default insurance. This is the most common type of private mortgage insurance, and it is usually required when you borrow more than 80% of the purchase price or your down payment is less than 20%. This is typically included in the monthly mortgage payments. The amount of premium depends on the size of down payment, the amount borrowed, and also credit scores. Sometimes this is also referred to as CMHC insurance, where the lender is protected in case of borrower defaults on payment, and this insurance is not related to borrower's death. So that's a whole separate topic I'm not going to cover in this video. So let's look at the other type of mortgage insurance, which is known as mortgage life insurance. This is a type of life insurance policy that protects lenders and not borrowers in case of borrower's death. That means if anything happens to the borrower, in most commonly situation like death, the remaining mortgage amount balance is directly paid to the lenders and not to the borrowers. So borrower needs to understand this most important thing, that mortgage insurance or mortgage life insurance is typically sold by the mortgage banking institution to protect their investment and not the borrowers. Now let's look at how life insurance works. With private or personal life insurance which is taken outside of mortgage, the borrower receives a defined amount based on policy data and not the lenders. So the payments can use to serve a lot of purposes, for instances like mortgage repayments, funeral expenses, children's future educations, and so on. So even with the life insurance taken outside of mortgage, there are two most popular options available: term life insurance and whole life insurance. And most commonly people go with the term life insurance where the policy is valid for certain years. For example, 20, 25 or 30 years, and after that period ends, the policy holder or the borrower is no longer eligible for the life insurance unless they purchase a new policy. Most people assume that their homes will be paid off and their children will no longer be dependent on their income when the policy terms end. So it is convenient and also cost friendly to go with term insurance instead of whole or universal life insurance, which usually comes in handy for estate planning for high net worth individuals. So now that we know what these insurance stands for in a nutshell, let's have a look at the advantages of having a personal life insurance on top of mortgage life insurance. With personal life insurance, the borrower chooses how much the policy should be worth for. On the other hand, with the mortgage life insurance, it only allows you to get insured up to the remaining mortgage balance. So as the time passes, the mortgage life insurance decreases with the mortgage remaining amount. On the other hand, with the personal life insurance, the policy stays same till the term expires. Another advantage of having a personal life insurance instead of mortgage life insurance is that the borrower gets the flexibility to choose the insurance amount, which not just pays for the mortgage replacement but also outstanding debts, funeral costs, and in some situations, income replacements. Unlike United States, where the borrower gets liberty of having 30-year fixed mortgages, Canada have shorter term mortgages like 2-year, 3-year, and max up to 5-year fixed mortgages. So after the mortgage term ends, borrowers are entitled to renew their mortgages. Some people might assume that they'll never change lenders, but it's quite common practice amongst buyers to shop around and look for the lowest rates when their mortgage is up for renewal. Banks do provide mortgage life insurance, and this may sound convenient, but when the borrower decides to change the lenders at the time of mortgage renewal, that life insurance from the existing lender does not transfer to the new lender. So borrowers have to buy a new life insurance policy from the new lender. And also considering the age factor, when the borrower decide to make this change, it will also cost more to have a life insurance from the bank. On the other hand, the private term or whole life insurance, the policy isn't affected regardless who the mortgage is against. In addition, this insurance allows beneficiary not just to repay the mortgage payments but also use the paid out funds as they please. As we discussed earlier, with mortgage life insurance, the insurance amount decreases over time as it is paid out to the lender at the end of the day when it is needed and how much it is needed to pay out the remaining mortgage balance. But on the flip side, the personal life insurance does not decreases with time. Both mortgage and personal life insurance does not pay for critical illnesses such as heart attacks or cancer diagnosis, nor does it pay when you become disabled. However, additional policies that covers these situations can also be purchased at the time of either of these insurance purchase. So there was a short summary and pros and cons of personal life insurance and mortgage life insurance. Now let's look at the cost differences between these two insurance. So here are a few instances of price compared with mortgage life insurance and term life insurance rates. So looking at these numbers, the average 20-year term of a $500,000 term policy for a 30-year-old both male and female is close to $30. And for the same age, if both decided to take out mortgage life insurance for the same amount, they would be paying about $75 a month. Well, looking at the numbers and use cases, there is definitely room for saving more money with private life insurance, and in addition, the flexibility that comes with it. Well, I hope this video have shed some light on this debate and provided you needed information. If you enjoyed this video, don't forget to like, share, comment, and subscribe. That's it from my side, guys. I'll see you next time.